Welcome back to Dinar Community Channel. You might think all IQD holders will walk into a bank and walk out millionaires, but that's far from the truth. While you're being offered $5 per dinar at the counter, someone else in the room is quietly signing a contract for over $6.50. Why? Because banks operate on tiers, and if you don't know how they work, you're leaving life-changing money behind. In this exposé, we reveal the hidden truth about IQD contract rates, secret exchange tiers, and what you must do before it's too late. Your financial future depends on knowing what they refuse to say out loud. The Iraqi dinar has long been a topic of both curiosity and speculation. In 2025, however, much of that speculation turned into financial reality with the confirmed revaluation of the dinar, sending shockwaves across the currency markets. As dinar holders raced to exchange their IQD for US dollars, a lesser-known and rarely discussed layer of the financial system began to surface: contract rates and exchange tiers. While many assumed they'd receive the same exchange value from any bank or redemption center, what unfolded was far more nuanced. Beneath the surface lies a system of layered rates, discrete contract arrangements, and strategic tiers that can determine whether an investor walks away with a modest return or generational wealth. This is what banks aren't telling you. To the average currency holder, the revaluation of the Iraqi dinar to an international value, say $6.20 per IQD, seems straightforward. A simple multiplication of dinar holdings by the rate gives a projected payout. But in reality, very few investors receive the so-called top-tier rates. Instead, banks and authorized financial institutions operate within a hierarchy of rates based on volume, relationships, holding periods, and internal contracts that are never advertised publicly. At the most basic level lies the street rate or the publicly posted exchange rate, what most retail customers will see if they walk into a bank with dinar and ask to convert. These rates often fall short of the actual international market rate, as banks build in spreads, conversion fees, and risk premiums. For example, while the official market rate may be $6.20 per IQD, a walk-in client at a major retail bank may be offered a rate closer to $5.60 or even $5 per IQD after all fees are applied. Banks profit from the difference, especially when dealing with high volumes of currency. Above the public rate is what is referred to in dinar circles as Tier 4 rates. These are privately negotiated rates offered to individuals who have pre-registered with wealth managers, currency exchange groups, or private banking programs. Often these individuals have attended seminars, participated in webinars, or have maintained long-term relationships with trust attorneys and financial advisors specializing in currency revaluation. Tier 4 rates typically range higher than public walk-in rates and may reflect up to 85–95% of the international rate, sometimes reaching as high as $6 or $6.10 per IQD. Even higher are Tier 3 and Tier 2 rates, which are generally reserved for VIP clients, high net worth individuals, or group exchange participants who pool their holdings to negotiate better rates. These tiers often involve contracts, escrow agreements, and specific conditions such as timed disbursements, required deposits into managed accounts, or philanthropic pledges. In these cases, individuals may receive rates equal to or above the posted $6.20 mark, but they're rarely offered such terms without prior setup and negotiation. The process can involve extensive vetting, compliance checks, and legal frameworks to ensure that the exchange complies with local and international finance laws. Then there are the elusive Tier 1 rates, often considered the realm of institutional exchanges, sovereign wealth groups, or highly connected insiders. While little is officially documented about these rates, whispers in financial circles suggest that Tier 1 rates could go as high as $7–8 per IQD or more in rare cases. These are not retail offerings. They are negotiated deals between large-scale holders and central financial authorities, often involving diplomatic channels or global humanitarian trusts. But why does this system exist? And why don't banks disclose it? At its core, the tiered rate structure allows financial institutions to manage risk, incentivize loyalty, and control the flow of money in the post-revaluation phase. If every holder received the top rate with no oversight, it could flood the system, create volatility, and disrupt economic balance. Tiered rates allow for a controlled rollout, rewarding those who followed proper procedures, documented their holdings, and maintained a clean financial trail. Moreover, Contract rates are often used to ensure that individuals receiving significant payouts are tied into long-term financial structures, such as wealth management programs, asset-backed accounts, or philanthropic commitments. Banks don't advertise these tiers because they are not obligated to do so. In fact, most banks rely on the assumption that retail clients won't ask. A currency holder who walks in expecting a simple transaction is often given the base rate by default. Without a contract, prior registration, or relationship with the bank's wealth division, they are unlikely to receive anything more. And in many cases, asking for contract rates outright may even result in confusion, denial, or vague responses from frontline staff who are either unaware or trained not to disclose sensitive tiers. Another often overlooked layer is the requirement for non-disclosure agreements. Many dinar holders who have received contract rates or participated in private exchange programs have been required to sign NDAs, limiting their ability to discuss the specifics of their rate, the institution they exchanged with, or the terms of their agreement. This cloak of confidentiality further obscures the system, making it difficult for the general public to understand what's truly available. The result is a financial environment where those in the know thrive, and everyone else is left with less. Take the example of a currency holder who exchanged 50 million Iraqi dinars through a private appointment with a Tier 4 group. After presenting documentation, confirming identity, and completing compliance steps, they were offered a rate of $6.05 with a $100,000 flat fee deducted post-exchange. In contrast, a walk-in client at the same bank with no appointment and limited paperwork was offered $5.45 per IQD. On a 50 million Iraqi dinars exchange, the difference amounted to more than $30 million in net proceeds, proof that access, timing, and awareness matter. Beyond rates, the structure of payouts also differs by tier. Higher-tier exchanges often involve staggered payments to avoid liquidity shocks, while lower-tier exchanges are immediate but lower in value. Some contract-based exchanges include buyback clauses, wealth manager requirements, or philanthropic earmarks, such as committing 10% of proceeds to a charitable fund. These conditions, while restrictive to some, can serve as a filter ensuring only qualified individuals access the top levels. There's also a geopolitical element to consider. The revaluation of a national currency on this scale carries international consequences. As such, some banks and financial institutions operating under regulatory oversight have discretion to limit access to higher rates based on nationality, residency, or tax jurisdiction. U.S. citizens, for example, may find different access pathways than European or Gulf-based investors. Institutions may require holding funds within their banking ecosystem for a certain period or restrict transfers above certain thresholds without additional documentation. All of these practices, while not illegal, exist in a regulatory gray area. The fact that some investors receive significantly more than others based solely on pre-existing relationships or insider knowledge raises questions about financial equity and transparency. Critics argue that this tiered approach favors the wealthy and connected while marginalizing everyday holders who were sold the idea of equal opportunity through revaluation. Supporters counter that the structure rewards preparedness and compliance, which are critical to maintaining the integrity of the global financial system. To further complicate matters, currency redemption centers, often operated separately from retail branches, have emerged as specialized venues for higher-tier exchanges. These centers, located in major cities or near financial hubs, offer enhanced privacy, security, and contract structuring not available in standard bank branches. Appointments are typically invite-only, require proof of holdings, and may involve interviews or preliminary vetting. Those who gain access often do so through referrals, legal counsel, or participation in structured currency groups. In response to the tiered structure, many dinar holders have begun forming groups or cooperatives to leverage collective bargaining power. By pooling resources and negotiating as a unit, these groups aim to secure better rates and terms. Some have succeeded in accessing Tier 3 or Tier 2 rates through this strategy. However, caution is advised. Not all groups are legitimate, and there have been reports of scams, unverified dealers, and unauthorized exchanges. Due diligence, verification of group credentials, and legal oversight are essential. Banks, for their part, continue to deny the existence of preferential contract rates in official communications. Publicly, most institutions maintain that all customers are treated equally and that rates are determined by market conditions and standard policy. Yet behind closed doors, the reality is very different. Contract rates exist, tiers exist, and the difference between a prepared exchanger and an uninformed one can mean tens of millions of dollars. The key takeaway for Dinar holders in this climate is to ask the right questions. Instead of walking into a bank and asking for the current rate, a well-informed holder should inquire about structured exchange options, private redemption appointments, and whether the bank offers enhanced or contract rates for larger volume holders. Building relationships with wealth managers, legal advisors, and certified currency professionals can also open doors that remain closed to the average walk-in client. In the end, the IQD to USD conversion isn't just about numbers, it's about access, information, and positioning. Those who approach the exchange with a clear understanding of tiers, contracts, and institutional structures are far more likely to receive maximum value. Meanwhile, those who rely solely on public rates or assumptions may leave untapped millions on the table. As more holders step forward with stories of their exchanges, patterns are emerging. The biggest returns go to those who planned in advance, documented their holdings thoroughly, consulted professionals, and gained access to structured tiers. While the banks may never officially confirm the existence of these contract rates and tier systems, the outcomes speak for themselves. The difference between $5.45 and $6.20 may seem small on paper, but across millions of dinar, it becomes life-changing. Whether you are a seasoned investor or someone just now realizing the implications of the IQD revaluation, the most important step is education. Learn how the system works. Ask smart questions. Connect with professionals. And when the time comes to exchange, remember this truth: what the banks don't tell you can cost you everything or make you a fortune. The choice is yours. Like and subscribe Dinar community for more videos.